What's up everyone, it's Kadi with MoneyVest. So in this video, I wanted to go over the Magnificent Seven. There was a report that mentioned that the current state of the market with respect to the concentration in the top 7 stocks kind of resembles very much to Nifty 50 and also very much to the 1970s stock market crash, which obviously resulted in a lot of these high-flying growth stocks to sell off pretty aggressively. So hope you all enjoyed this video and find it helpful. Make sure that you drop a like and of course subscribe to the channel if you haven't already. I would really appreciate that. And link to our Discord and Patreon is going to be down below if you're interested in joining and of course getting access to all the members only private videos, Discord channels, trade alerts, trade ideas, Excel spreadsheets, members only private videos. Everything is going to be included with the link down below. So we'd love to have you on board. If you have any questions, feel free to reach out and also connect with me on Instagram. I do post a lot of interesting polls, strategies, tips, reels, personal finance videos. All that's going to be included on my Instagram. My handle is going to be CASWRP. Link's going to be down below for that as well. So this right here is the report. Investors beware. Magnificent Seven are starting to resemble Nifty 50 stocks that got crushed in the 1970s market crash. So this right here was a report. So apart from representing extreme levels of concentration in the US stock market, the company's earnings multiples appear comparable. This was Apollo Global Management's Torsten Slok recently showed. And Slok also compared Magnificent Seven multiples to the S&P 500's IT sector of the dot-com era and found some similarities there as well. Investors should be eager to glean any lessons that they can from the Nifty 50 era, given what happened to those stocks during the bear market of 1973-1974. So Nifty 50 is basically a Indian stock market index, mostly for growth companies in the tech sector. And that obviously did drop quite aggressively because of the higher valuations that got up to extreme levels in the 1970s and 1974. During punishing the 2-year stretch, the S&P 500 fell by more than 40%, according to FactSet data, which shares of many of those market leaders seeing even larger declines as well. And the issues of whether their high valuations were ever truly warranted remains a subject of debate among academics studying the financial markets to this day. As Slok sees it, lofty valuations for the Magnificent Seven should make investors think twice about investing in the broader S&P 500, given these stocks now make up nearly 1/3 of the index's aggregate market value, according to Bank of America as well. And this right here is the S&P 7, so Max 7, right? And stocks are overvalued as a Nifty 50 and in tech in 2000 as well. So what you'll notice is, of course, the trailing price to earnings multiple for these 7 companies like Meta, Amazon, Apple, Google, Microsoft, Nvidia, and Tesla. And the average price to earnings multiple is at 53, right? So very, very expensive at the moment. And of course, the tech bubble did have a very, very significant valuation. So average P multiple back in March of 2000 was 62. And Nifty 50, we did see, of course, average price to earnings multiple of 56 as well during that times of 1970 to 1974. So they're basically drawing comparisons that, look, valuations have gotten to extreme levels after the rally that we have seen. And also the concentration of these 7 stocks in the S&P 500 has also become a much bigger topic of discussion because now it makes up over 25, close to 30% of the overall index. So that's where we are with the market valuations. Now, I would argue that, of course, going back as far as 2000s or 1970s, there was concerns related to revenues and earnings because a lot of the growth that was happening in individual stocks was happening on the back of stories and not a lot of financials, right? A lot of these companies that we are looking at, Magnificent Seven, like Meta, Amazon, Apple, Google, Microsoft, Nvidia, Tesla included, these are super profitable, extremely well capitalized, very, very strong moats, advantages in their specific markets and competitive dominance in their specific markets as well. So while the valuations may be at an extreme compared to what we have already seen in the past, they have the sort of financial statements backing to justify some of these valuations. Now, the future is what really matters because investing requires us to deal with one thing that is the future, and the past is already done, right? So while one can argue that these valuations are justifiable just because what the companies have done in the past, can they be justified depending on or considering what the future is going to look like for these companies? Now, that's a whole different topic of conversation because for me personally, I believe Apple on a growth adjusted basis, Microsoft on a growth adjusted basis, even Tesla and Nvidia on a growth adjusted basis are somewhat overvalued. Meta is reasonable, Google is reasonable, Amazon has never really focused on profitability up until now. And of course, there's that Rivian acquisition that's also playing a bigger role. So Amazon, I would argue, growth is very strong in terms of bottom line earnings. 68 still very, very high, but of course, it's got a lot of potential in terms of, and I've already said this before, like among these Magnificent Seven stocks, I believe Amazon is actually going to come out on top with earnings growth over the next 10 years. In fact, much better than that of Nvidia and Tesla over the next 10 years. We'll find out if that one prediction that I've made is going to be accurate or not, but I do believe Amazon actually has the best growth potential when it comes to the bottom line. Not the revenue, but bottom line earnings is what I'm talking about when it comes to the future. Now, the divergence between S&P 7 and S&P 493 continues, which is basically the other 493 companies. And investors buying the S&P 500 today are buying 7 companies that are already up 80% this year and have an average price to earnings ratio above 50. That's what they mentioned, because in a nutshell, that's really what it is, right? Majority of the gains and majority of the returns, majority of the profitability has come from a very small percentage of stocks, which is basically Magnificent Seven, right? So 7 divided by 500, we're looking at less than, 1.4%. So over 90% of the gains have come from less than 2% of the companies, right? That's the tail events, right? That's also mentioned in the Psychology of Money book. Morgan Housel talks about it in quite detail. And to take things even further, what you'll notice is that these 7 companies, right, their hiring processes, their talent, their management, that's really is what is creating a lot of this value and the returns. So we could basically even bring it down even further and say over 90% of the gains are coming from less than 0.000 whatever 5% of the people in the world, because the management teams and the people working at those 7 to 8 companies are doing incredible things. They're doing definitely something right. And as a result, there's more value creation for those companies. And that's, as a result, stock prices are moving higher for those companies more than the other 493. And as a result, it's taking the entire index higher with it, and the concentration is growing. So that is both a good and a bad thing. Of course, good because these companies continue to be the bedrock of the US economy and, of course, the financial markets. But the bad thing is obviously that they are the bedrock and the concentration risk that they carry. Now, in fact, S&P 7 valuations are beginning to look very similar to the Nifty 50 and the tech bubble in March of 2000. Why should investors be concerned about valuation? Because over the long term, though, like I said, the future, right? Valuation and future returns, because we talked about this, investing requires us to deal with the future, and future is really what matters over the long term, tend to be inversely correlated as shown by the chart below. And the higher the valuation today, the more muted the gains will be over time, although there is still plenty of room for valuations to continue to climb over the short term as well. This right here is a good sort of exhibition of the variability of the returns with respect to where valuations end up being. And you can see the longer the time goes on, so anything that's over 8, 9, 10, 11, 12 years, returns tend to be more and more influenced by where valuations are. So in other words, higher valuations leads to lower potential returns because the price is already really high, and going up from really high prices to higher prices is far more difficult than going from, of course, low prices to high prices. So as I've mentioned before in my previous videos, your future returns are going to be completely and independently dependent on the price paid. Price paid is what determines the future returns. If you pay a high price, then your future returns are going to be lower. If you pay a low price, your future returns are going to be higher. It's that simple. So valuations are nothing but a reflection of where the price is. If the price is high, valuation's high. If the price is low, valuation is low relative to, of course, the earnings and the cash flows. Now, in this example, of course, we've talked about how valuations are high for Magnificent Seven stocks, and we've talked about the technicals being overbought and overextended. Now, both of these things can remain at these levels for a long time. Markets can remain irrational longer than you can remain solvent, right? That's something that we have talked about. So markets can indeed remain overvalued and remain overbought for a very long time. That doesn't necessarily mean that we're going to see a pullback or a correction. However, the risk reward is what we're here to study, right? So risk reward is what we are here to analyze. So from a risk reward perspective, both on a fundamental and on a technical basis, that is unfavorable on the long side. And that's exactly one of the reasons why I'm not taking any long trades and I'm not aggressively buying a lot of these Magnificent Seven stocks. Diversified ETFs, that's a whole different story. We've run the experiment for the last couple of years. I'm still going to continue dollar cost average into that. And this right here is basically US is near extreme peaks versus global equity. So the returns have been incredibly strong if you take a look. And of course, we are very, very incredibly high in terms of the returns and how the US markets have performed relative to the world, excluding for US equities. And it's way above 2.3, 2.8 standard deviations higher than the global markets. Now, this continues to show two things. Number one, how strong the US economy is and how strong the US markets have been over the last year and how much momentum we have seen in Magnificent Seven. Like I said, it all comes down to the 7 stocks and 7 companies. They're the ones that are driving majority of the returns. They're the ones that are concentrated heavily in the indexes. The other 493 companies are just slowly and steadily moving higher. In fact, if you take a look at the equal weighted S&P 500, we haven't really seen a lot of momentum this year. In fact, it's a very flat, slightly higher on a year-to-date basis. So that tells us that broad-based participation is lacking from the market, and it's really just the big tech and large cap 7 companies that are pushing higher. Now down near record high because traders are calling bluff on higher for longer Fed. And this right here is the odds of the Dow Jones rising in December. So December is here, seasonality wise, as we know, there's over a 70% probability the markets are going to be green, right? So very, very strong month potentially on a seasonality basis. And this right here are different odds for when the markets are up through November, when the P ratio on November 30th is above the historical median, and when the CAPE ratio on November 30th is above historical medians as well. And none of these basically cross over 75 to 80%. So there's not a lot that we can draw in terms of conclusion. What we can really draw in conclusion is that, okay, December seasonality-wise is strong. There's a 75 to 80%, up to an 80% chance that markets are going to be green. There's going to be a Santa Claus rally, but there are exceptions, of course. In 2000, December ended up with a gain of 3.6%, even though the markets were down 10% going into December. So up until November, they were down. And then, of course, last year in 2022, Dow fell an additional 4.2% in December, even though we were down up until November of last year as well. So, of course, we have to take it on a year-over-year basis. But this right here is definitely suggesting and continues to validate that December, historically, seasonality-wise, has been a very strong month. So, bottom line is, as we have already discussed on the channel multiple times, that I think the valuations for a lot of these Magnificent Seven companies are somewhat extreme, right? We've talked about this. Technicals are overbought and overextended. So from a risk-reward standpoint, I think caution is something that I'm going to continue with. Cautiously optimistic is where I am at with this market. But at the same time, I think there is going to be some opportunity. There's 3 things, right? There's a soft landing. There's the hard landing, which is basically recession while inflation is back down. And there's basically the worst landing, which I like to call it, where inflation and unemployment, they're both up at the same time. So really, we have to understand that which of these 3 scenarios is the most likely. Soft landing, very likely scenario considering what we are witnessing with unemployment rate not really going higher. Next week is unemployment week, so we'll find out more with respect to jobs, but it's still pretty steady, still pretty low. But of course, if we start to see some cracks in the labor market, unemployment starts to go up, that's going to be a much bigger problem for the Fed. And they're really hoping that by the time that happens, inflation is back down to their target, or in fact, even lower. That's going to make them very happy so that they can now start focusing on rate cuts and bringing economy back up to speed. And of course, unemployment is going to be the main concern if there is a recession. So hope you all enjoy this video. All my alerts and my analysis will be shared in the Discord as well. Link's going to be down below if you want to join. Of course, be a part of our MoneyVest community. We'd love to have you on board. As always, happy investing. I'll see you all in the next video.